Hello, we're going to now look at some examples to apply the concepts we've talked about so far in measurement fundamentals. We're going to look first at accounting fraud, and accounting fraud in particular about the bankruptcy of WorldCom. And the newspaper reported that this fraud was brazen and easy to spot. The scheme was not complicated. The company's financial officers basically recorded routine maintenance expenses totaling $3.9 billion as capital expenditures, which can be written off over decades, rather than booking them, as they should have, immediately as expenses. So converting that into accounting, that means that the officers debited an asset, which made your assets go up, credited your cash, which made your cash go down. So they just swapped one asset for another and kept it all on the balance sheet. What they should have done, since this was routine maintenance expense, kind of like you changing the oil in your car or maintaining your bike, is you should have debited repair expense, which would have made your expenses go up and your net income go down. Also, your cash would have gone down because that's an asset. So what they were doing basically by capitalizing an item was keeping the resources on the balance sheet and not moving any of the current costs of doing business onto the income statement. So they just didn't expense it. So by not expensing it, their net income would be higher by, in this case, $3.9 billion, because they chose to keep all those costs as having future or potential value instead of recognizing they were really just maintaining the equipment of the business. So your net income was higher, and thus the investors thought the company was doing fabulous and invested in the stock, until it got so large that it all fell apart. Part B, which principles of accounting have been violated? So listening to what you've learned so far in here, we know that number one, materiality, $3.9 billion. If you did know about that as a user, you probably would have changed your mind about the business decisions you made. Conservatism, which says you recognize your losses early. So in this case, notice we were putting it off as long as possible by keeping them on the balance sheet. We also violated matching, which says that we recognize all costs that it took to generate that revenue against the revenue of that period, and notice instead we were keeping it as assets. And also consistency, which says that other companies would have expensed these routine maintenance expenses as expenses, and WorldCom was deviating from this consistent approach to repair and maintenance expenses. So that's our first example.